The UK construction industry is poised for expansion, helped by a seemingly pro-construction government. However, there is a complex mix of pent-up demand, caution and market uncertainties in the short to medium term. The impacts of the autumn budget and the implications of the US presidential election are not yet fully known. Therefore, cautious optimism must be tempered by the challenges affecting the sector. In this update, I'll cover the overall market outlook. Paul will discuss construction output, materials and contractor capacity, and Mike will address the labour market and government impact. Inflation is now nearing target levels as the Bank of England has reduced interest rates from 5% to 4.75%, which might encourage development. However, future interest rate cuts are expected to be slower and less frequent. The autumn budget's focus on growth may keep inflation above the bank's 2% target until 2029. This effect could be worsened by national insurance changes, potentially delaying further rate cuts. Following the US election result, there is potential for protectionist policies, such as tariffs, which could contribute to UK inflation.
Construction output rose in Q3 to 0.8%, outperforming other key sectors of the economy. However, in September, output dipped as a result of uncertainty ahead of the budget. Certain sectors in the construction market face a contractor shortage, with high insolvency levels affecting the supply chain and reducing capacity. Consequently, clients will need to review their approach to procurement and consider an appropriate balance of risk between the developer and the contractor. Material prices have been stable in 2024, with less volatility in materials like steel, rebar and imported timber. Interest rate cuts may ease financing pressures and spark more construction activity. However, if many projects begin at once, manufacturers might struggle to meet demand, giving suppliers more pricing power. To mitigate against capacity issues and price hikes, clients should schedule projects strategically and lock in supply agreements well in advance.
The overall UK unemployment rate rose from 4% to 4.3%, signalling a slowdown in the general jobs market. However, the construction industry still faces a significant skills shortage, with its workforce shrinking by a substantial 15% since 2019. This is mainly due to demographic trends and new salary requirements for migrant workers. This shortage is driving up wages, with average weekly earnings rising by 5.4% in September, above the long-term average of 3.1%. In terms of the Labour government's impact on the construction sector, its first budget brings a large increase in spending, taxation and borrowing. Rising employer national insurance contributions are likely to be inflationary, as we'll start to see businesses pass these additional costs on. These labour cost pressures could have a knock-on effect on project progress, impacting any potential recovery.
To summarise this quarter's key takeaways, the Labour government appears supportive of the construction sector, aiming to increase investment and streamline planning policy. However, the appetite for property development remains mixed. While lower interest rates are a step towards improving project viability, they are unlikely to drive sufficient growth alone. A cautious outlook persists as contractor capacity, material price inflation and labour costs remain key challenges. We recommend working closely with your G&T advisor to model scenarios, strategically time your projects and implement proactive strategies to navigate current market pressures effectively.